All right. Welcome, everybody. It is Thursday, May 29th, 2025. I'm joined here again with Morgan Holmes. It's been a minute, and we are talking tax breakdown, the one big beautiful bill, where it stands right now. How you doing, Morgan?
Doing great.
Great, great. Glad to have you. I know it's been a while. It's been a while since we talked tax. We've had a great run of guests here, but I'm glad to have you back. Take a little breath off of tax season. And yeah, so I want to go in today and make it real valuable. I mean, you've taken a chance, you've read through what's passed so far, and just kind of want to hear what's the first thing, what's the intro, the big thing on the one big beautiful bill.
Yeah, I think the big thing is there's a lot of stuff in this big one big beautiful bill. And
Absolutely.
what I tried to do for this presentation is to go through the one big beautiful bill and kind of strip it down to what are the big things that are going to be applicable to most business owners as well as the businesses themselves. So, there's a lot of stuff in this bill that probably doesn't pertain to most people, most taxpayers, but there's some good stuff in this bill.
Absolutely. So, yeah, and in regards, most of our clients and most of the listeners on this show are going to be business owners, service business owners primarily, our MSPs, agencies, startups, etc. Let's just start. I mean, maybe on the individual side, I think that makes it a little bit more of a broader conversation. Typical business owners, let's say over 80 to 100,000 and up from there in income a year. What are some of the things around the individual tax implications?
Yeah, for the most part, I think the biggest thing in the bill, or the main purpose of the bill, is to extend the 2017 tax cuts, the Tax Cut and Jobs Act. So there's a lot of tax breaks that were given back in 2017. All of those provisions, or a significant portion of the provisions that relate to individuals, were set to sunset on December 31st of 2025. And the president and the Congress uh, are aiming to try and extend or make permanent a lot of those individual provisions. So that's the probably the biggest thing that's going to affect the average taxpayer, the average business owner, is again the extension or making permanent some of those TCJA tax provisions.
Yeah, and for instance, that includes the individual income tax rates. I know it's the standard deductions is increased to where it is currently. What are some of the other provisions? Is it everything in the individual side that's preserved, or is it a pick and choose?
I wouldn't say it's everything, but it's a significant portion of it. So, for example, the increased AMT exemptions, that would have a significant impact. The state and local tax cap, although it's still going to be there. They're looking at increasing the state and local tax cap, and we'll get to that. But a big piece of what's in there, the qualified business income deduction, they're trying to extend or make that permanent as well. So
Got it. Got it. Yeah, you mentioned about the state and local tax. I know that there was it historically has been 10,000. It's increased, correct?
in the House bill, so in
Got
the
it.
House version of the one big beautiful bill, they've increased it to $40,000. So and from 10 to 40,000, which is pretty much going to cover a lot of business owners, and the increase is up to 40,000, but also, once you get beyond 400,000 of income, it starts
Got
phasing out. So it's not gonna benefit people that are paying millions of dollars in state taxes. So, probably more of America will benefit from the SALT cap increase.
Yeah, especially those in our high tax states, our New York's, California's, Texas's property tax, definitely a high one down there. So that'll definitely help on that side. And you mentioned about the AMT or the alternative minimum tax. What were some of the changes on that side?
So the exemption went up,
Okay.
is probably the big piece of it. I recently went on to the House Ways and Means Committee. You can see a breakdown of how if the TCJA sunsets,
Mhm.
what the impact by state. So I'm in California, so I looked at California, and currently the law, they estimate, impacts 200,000 people in the state of California. So maybe 200,000 people are in AMT, the rest of the people are not. if the TCJA were to sunset, that would go up to, I think it was 7.6 million people would in
Wow.
California
Wow.
would then be an AMT. And I see that in my client base too. I have very, very few clients that are in AMT, whereas pre-TCJA, a significant amount of people were in AMT. So
Wow. Yeah, that's definitely a significant increase between the two. What about itemized deductions? Anything on the itemized side that's changing there?
well, I mean, other than the state and local tax cap, the mortgage interest limitation is staying. The non-deductibility of reimbursed or unreimbursed employee expenses is still going to be 0. So probably not a lot is going to change in that area other than the significant changes to the SALT cap.
Got it. Got it. So that's a big one. What are the new provisions, at least on the House side, where it stands now on individual tax, income, tax levels, tax rates? What are some of the provisions
Yeah.
there?
Yeah, some of this isn't going to pertain to a big chunk of our clients, but I threw it in here because we hear Donald Trump talk about, no tax on tips. That is definitely in the House bill. Um, I recently saw too, I think the Senate passed a bill recently that no tax on tips. So seemingly they're in parity there. No tax on overtime is in the House, one big beautiful bill. There's an enhanced deduction for seniors. So if you're 65 or older, there's a $4,000 deduction for an above the line deduction for each senior on a tax return. Um, they've there's no tax on car loans or on the interest on the car loans. It's
Okay,
up to
wow.
$10,000 for a qualified passenger vehicle. A lot of this stuff has phase outs too. So this particular section, the no tax on car loan interest, if your modified AGI or adjusted gross income is over 200,000, you'll be phased out of this.
Got it.
There's some savings accounts that the Trump administration wants to put in place, or the House has included in their bill, where if you have a child that's 8 years or younger, you can put $5,000 a year into that until the child turns 18, and they can use that for school and stuff like that. Um, and then there's the elimination of a lot of the renewable energy credits. So in the House bill, they've stripped out a lot of the credits that were passed by the Inflation Reduction Act. So credits for previously owned clean vehicles, the clean vehicle credit itself is going to be terminated. Any of the energy and efficient home improvement credits, so heat pumps, windows, insulation, that credit was expanded with the Inflation Reduction Act of 2022 to $1,200 a year. That will go to 0 after 2025. Residential clean energy credits, which are the solar panels and battery pump or battery storage, stuff like that, the 30% credit. 2025 under the House bill, the 2025 will be the last year of that credit. So yeah, there's more, but these are
Got
probably
it.
the ones that affect most people.
Definitely the highlights. That's great with the enhanced deductions for seniors for sure. It's great. But what does this mean for business owners? What should business owners be thinking individually? Let's say they're in their mid-year debating what they should do for the next 6 months, given that these provisions may or may not take place.
Yeah. So some of the business tax impacts, one of the big ones that we dealt with back in the TCJA when in late 2017, early 2018 was the corporate tax decrease from
Yeah.
35% to 21%. So that 21% tax rate is going to stick around. The thought there is that the 21% tax rate makes the United States globally competitive with other countries throughout the world. Bonus depreciation is a big one. So, we've had bonus depreciation for many, many years, and it's changed. It used to be
Yeah.
only new property, then it changed to, you can take bonus depreciation on used property. With the TCJA, the Tax Cut and Jobs Act of 2017, that bonus depreciation was being phased out to
Yeah.
where In 2025, the bonus depreciation percentage is 40%. So if you purchase a piece of equipment for $100,000, your bonus depreciation would be 40,000, and then you'd be able to take regular maker's depreciation on the rest. The House bill wants to bring back the 100% bonus depreciation. So if you purchase that $100,000 piece of equipment, you're going to get a $100,000 deduction for that. So that's great. It helps our clients and businesses recover their investment in capital expenditures. Section 179.
Yeah, it's a
Again,
big one for all of our clients for sure.
It is a big one, and I see quite a bit of it. Section 179 currently is $1 million. So and it phases out after $2.5 million of additions. The proposed Section 179 under the House version of the One Big Beautiful Bill is $2.5 million of Section 179.
Wow.
It phases out after $4 million of property
That's
placed in
significant.
surplus. Yeah, it's big. But I mean,
Especially for the smaller organizations, those under 50 million, even 10, 15 million in revenue who get that boost, especially if they have a large investment on their side, MSPs and equipment, digital agencies and software and other opportunities there. So that's awesome. I mean, that's
yeah,
hopefully,
yeah. Mostly what's going to happen though is, if you buy $100,000 piece of equipment or, $1 million piece of equipment, you're probably going to take bonus depreciation over Section 179. But there are instances where 179 makes more sense than bonus.
absolutely.
The pass-through entity deduction or qualified business income deduction, that was put into place with the Tax Cut and Jobs Act in 2017 as a 20% deduction on qualified business income. That's going to get expanded. So we still have that 20% deduction for 2025. After 2025, that qualified business income deduction goes from 20% to 23% under the House bill.
Definitely a solid boost.
It is a good thing.
So that applies to a lot of our clients since we have so many partnerships, S corps, anybody who's really that pass-through entity, sole props, and especially those that are the individuals. Maybe you have 3, 4, 500,000 in income, and you're a self-employed individual or the sole proprietor. It's a nice boost to have that, especially from a cash flow perspective. Does this change? Would these change any of the tax planning? Any of these things that we've mentioned so far for many of our clients?
It certainly will. I mean, oftentimes with S corporations, we talk about reasonable compensation, right? So,
yeah.
If your compensation is too high, then effectively what you're doing is reducing your taxable income. And as you reduce your taxable income, you're going to get less benefit from something like the qualified business income deduction, right?
Got it,
So
got it.
it makes that reasonable comp analysis even more important because now we want to make sure that we're not overcompensating ourselves and reducing our benefit from things like the qualified business income deduction.
Yeah, and I think that's one where we see it. I mean, not just because you're an S corp doesn't mean every S corp is doing that. Really, a true reasonable comp analysis every single year, and that's why we implement that as a standard planning on the tax planning side. Because yeah, it's interesting to think that hey, yeah, you have to pay yourself enough, but you don't want to pay yourself too much as it relates to the W-2 wages. Because of that, then it's just gonna further reduce what you can take at the much lower capital gains and the pass-through entity rate when you're distributing profits from the S corp. So.
Yeah.
Definitely a big one there.
In addition, when you're paying yourself too much, not only are you reducing the qualified business income deduction, but for most states have a pass-through entity tax credit. California has one as well, and it's based off of your taxable income as well. So again, if you're paying yourself too much, reducing your taxable income in your business entity, you're also reducing your ability to take the QBID or the qualified business income deduction and the pass-through entity tax credits for your state. So again, reasonable comp is an important piece of the tax planning strategy for a pass-through entity.
Absolutely. You had mentioned around bonus depreciation section 179. For a refresher for some of our other listeners, why would you choose one or the other?
Yeah. So bonus depreciation is mandatory. So you have to take it unless you elect out of it. And when you elect out of bonus depreciation, you're electing out of it on a class by class basis. So you say, okay, I'm not going to take bonus depreciation on any 5 or 7 year assets, right? Section 179, you can elect how much 179 you want to take. So if you're trying to hit a taxable income target, you're most likely going to elect out of bonus and take 179 because you can then figure out exactly where you want or need to be.
Got it. Got it. Yeah, I appreciate that. I think that's one where there's a lot of common misconceptions, especially when I'm talking to prospective clients or other partners. It's, hey, I don't really know what it means. I know I do it, but I don't know why I would elect 179 versus taking just the standard bonus.
Yeah.
What other tax implications in the one big beautiful bill for the business side? I know there's something around R&E capitalization. I've heard a
Yep.
lot about
Yep.
that.
So included in the Tax Cut and Jobs Act of 2017 was this requirement that entities or taxpayers that are doing any research and experimental activities would be required to capitalize and amortize those activities over 5 or 15 years, depending upon whether the activity was a domestic activity or a domestic expense or foreign expense. And that provision, even though it was passed with the TCJ in 2017, didn't start until January 1st, 2022. And leading up to 22, everybody thought, hey, this is going to go away, right? There's no way that the government is going to make, companies capitalize all these expenses. And, to put it in perspective, Google has billions of dollars of capitalized expenses. I mean, there's a lot of capitalized expenses. So we've always, thought that this was going to go away. The House passed a bill, I believe it was early 2024, that would eliminate the requirement to capitalize R&E expenses. That never got passed. Never got through the Senate. In the one big beautiful bill, they've tried to fix some of it temporarily. And what it is if you're performing R&E or you have R&E expenses, you're doing software development or anything like that, then if those expenses are domestic, you don't have to capitalize them after 2024. If they're foreign R&E expenses, you would have to capitalize and amortize those over 15 years. So essentially what they've done is taken out the domestic piece temporarily, at least. For 2025 through 2029, you'd be able to deduct those expenses. Beyond that, we go back to, unless the tax law changes, we go back to capitalizing and amortizing domestic and foreign expenses over 5 and 15 years, respectively. So this is a big issue too. I mean, I have clients that get grants. Grants are taxable income. They then take that grant money and spend it on R&E. And then, let's say you took $1 million of grant money in, you spent $1 million of your grant money on R&E. You now have to capitalize $1 million of expenses and amortize it over 5 or 15 years.
Yeah, instead of just being able to take it right then and there because you already incurred the cost. Yeah, that's definitely a big issue.
So those types of businesses went from having losses, right? Having, either break even or losses to actually having taxable income and owing tax to the government.
Yeah. Which slows down. I mean, definitely slows down innovation. It forces them to then have to go do, subsequent capital raises if they're in the startup world and they're taking funding. I mean, it's interesting when you think, because it's like the implications of, let's say, a Google having billions of dollars of that on their balance sheet and it's still amortizing it over years and years. It's interesting to think about that as a whole and what that does to innovation too.
Part of the fix in the House bill that was passed a year or two ago was that they would make it retroactive. So all the way back to January 1st, 2022. And there was talks about that maybe in the one big beautiful bill. I think that they shied away from doing something like that because the tax impact of that is gigantic, right?
Yes.
I mean, can you imagine if they made this retroactive and Google then said, oh, great, I can remove, $6 or $10 billion off my balance sheet, right?
Yeah.
So
And then the implications to the federal budget, expecting, hey, we were going to have taxing. And you know what? Actually, we don't have that tax revenue. That's gone, and what that would do. So I
Yep.
definitely, like to your point, there's going to be changes. I mean, it's tough to say. It's only through one part of our government so far. It's only through the House, so you never know what's going to change once you get it through the Senate.
Yep.
Now, anything around? I think there was something. The other thing for businesses was around 1099 reporting.
That's right. So I think everybody, especially us accountants, CPAs, and
Yes,
bookkeepers, are excited about
yes,
this. So every January, we scramble to try and get our clients to do 1099s. The reporting threshold for years has been $600 for,
yeah,
you know,
a
if you have
long time.
subcontract. Yeah, yeah. And it's a lot of work setting up 1099s. But for years and years, it's been $600. Um, the House bill is proposing to increase that to a $2,000 threshold, and then adjust that for inflation. So every year will go up a little bit. So
Very nice.
we hope this ends up in the final one big beautiful bill,
Yes,
because it cuts
yes.
out a lot of work for our clients and for us. So
Especially when you're already busy during tax season at the beginning of tax season in January, especially for us closing books and getting prior periods and trial balances and all that ready. It's just, you pay a contractor one time or with them to work with you and you don't never use them again, but you still are required. And I think $2,000 at least, it's a start. It's definitely a start from an increase because it's been 600 as long as I've known taxes. And that's, relatively long, not as long as some others, but it's been there for quite some time. So that's definitely a nice burden relieved if it
yep,
makes it through.
yep. Like I
Now,
said, I hope.
timing. What does the timing look like for this? I mean, I know I've heard some different dates, maybe end of summer, early fall, early summer. What is the most recent target date for this?
Yeah. So the target date that I have been that I've read is that the Republican Congress, both the House and the Senate, want to try and get this done by July 4th.
Got it.
So that seems awfully aggressive, right? I
It's
mean,
quick.
yeah, that's coming up. It's going to be here in like just over a month. And the Senate is just starting with this, right? I mean, obviously, they have their own beliefs on what should be in the one big beautiful bill, and it's seemingly a little bit different than what the House is. The
Of
House
course.
passed this bill by one vote. There's
Yeah.
a handful of senators that are saying they oppose certain pieces of this, so the Senate has to get it through their version through the Senate onto the Senate floor for a vote. And then any differences between the House bill and the Senate bill then have to be reconciled between the two houses of Congress. So it seems to me
Uh,
like this is going to take a little bit of time.
and what you're saying is we'll be doing another Stride Live here, breaking it down in about a month, month and a half.
Yeah, hopefully less, but
Hopefully.
not likely. I think we'll be
So
doing a Senate bill one, right? So once the Senate passes the version, we should do another Stride Live on, a comparison of the House bill and the Senate bill. And then
absolutely.
yeah, I would imagine though, shortly after we get the Senate bill, we should we should get a reconciled bill and hopefully to the president to get this signed.
Hey, as long as it's not coming across into November, December, October, quarter four, when it's almost too late to make any changes and decisions within a business, the sooner the better for sure.
Absolutely. I mean that's I mean, I think you hit on a key point, right? So we're looking at things in this House bill. We don't know what the Senate is going to do.
No.
But in the House bill, we have all these renewable energy credits going away, right? So if you were thinking about doing solar panels or putting that battery storage unit onto your home,
Yeah.
you might want to start thinking a little harder. Like, am I going to do this in 2025, right?
Yeah.
But I also know that the Senate is not a big fan of stripping out a lot of these renewable energy
Yeah.
credits that are out there, right? So who knows what's going to happen, but it's worthwhile starting to think about, do I start accelerating some stuff? right?
Yeah, and that's not just solar panels, everybody. That includes your doors, that includes your windows, anything around the vehicle's the same. So if you're looking at electric, if you're doing any sort of insulation, I know myself, I'm saying, hey, I gotta get my doors and windows done this year because I want to take advantage of that just in case. It was already on the docket, but making sure that I don't wait too long and say, oh, it's already December. So I would
Yeah.
definitely, take a look, everybody. If you haven't taken a look at this, read some of the highlights. We'll have this available. We'll have a nice summary blog put together on our website, stride.services after, so you can see some details. Morgan, anything else? Any, 1 minute snapshot? Hey, too long, didn't listen. The most important facts of this, the one big beautiful bill.
Yeah, I mean, again, the one big beautiful bill on the House version of the one big beautiful bill has a lot in it. Again, I only hit the highlights that I think are important to business owners and the businesses themselves. There's a lot of other stuff in these. You can go onto the House Ways and Means Committee's website and download a 47, I think it's 47-page document that kind of shows you section by section of what's in the one big beautiful bill, and old law, new law, so that you can kind of get a see where this is going. But hey, if you want to read the full 1,000-page bill, you could probably pull a copy down from the Congress website. So,
All righty. Well, Morgan, once again, thank you. I appreciate you taking the time today. I know you're always busy, so appreciate taking the time to educate us on tax and break this down for us.
you bet. Thank you. Thank you,
All righty.
everyone.
Bye.
Bye.